Okay. The E-mini today could have gapped above the all-time high, the blue line, and it did not, which I think is pretty interesting because in the Globex session, it was trading 5 points above the all-time high and sold off. Globex session pretty quiet. Anyway, we gapped up. We're right below the all-time high. Obviously, the odds are we're going to get a new all-time high either today, in other words, before or after the FOMC announcement, or we'll pull back for 2 or 3 weeks and then get a new all-time high. I've been talking repeatedly how all the way up, it looks like it's going higher, it looks like it's going higher. I did not think it would go this high, but there was no credible top all the way up, and any reversal was likely to be minor, 1 bar, 1 bar. This is the weekly chart, and that's still the case. So even if we try to form a double top up here with the September high and sell off, it still probably will only be a 1, 2, or 3 week pullback. It's unlikely that a bull channel that is as tight as this can convert into a bear trend. Here we got a micro double top. We need at least a micro double top. Here we had consecutive buy climaxes, and we have it here, this and that, but it's really not that dramatic. And so we're not as overbought as we were through here. So I think the odds of a big reversal down are not very big. So I think there's not a lot of downside risk. Typically, when you're testing a prior high, you go sideways, or you pause, you can pull back a little bit, because you have profit takers. You have bulls who bought down here, happy to get up to test the prior high. You have bulls who bought here, and they're relieved to be able to get out break even. So these bulls are selling, these bulls are selling, and they're usually not a lot of bulls buying up here, or not enough bulls buying up here to go straight up. So typically you stall. You stall for a number of bars, 5 bars, sometimes 10 bars. So the odds are we're probably going to convert from a very strong bull trend into a trading range for the next several weeks. Possible parabolic wedge, 1 pullback, 2 pullback, 3. Possible high of the day, possible final flag. So it's a credible sell if 1 closes on its low. Because the channel is tight, it's not a high probability sell. But yesterday's close is a magnet, yesterday's high is a magnet, and the moving average is a magnet. Not a good sell, right? If you're selling, especially if you're making a trade on the first bar of the day, you want the bar to close on its low. That we dipped below the Globex low. 90% chance you're going to break out of the Globex range either by going below the Globex low or above the Globex high. This is a 15-minute Globex chart. So that we achieved that goal there. If I'm looking for a trend from the first bar, let's say a bear trend from the first bar, I want to see 2 bear bars, and I want to see one of the 2 bear bars having a reasonably good sized body, and I want the bar to be closing on or near its low. So to sell below 2, I would want 2 to close on or near its low. Is that big enough to make it a sell the market bar? It's barely big enough, but I would want the bar to close on its low. We fell below the Globex low, and we closed the gap above yesterday's high. And we have a potential magnet here. Anytime there's a tight trading range, it's a magnet. We were in a bear trend, tight trading range, broke below it, came back to it, went above it. So magnet here, magnet here. I always pay attention to the size of the bodies, especially early on, and they give an indication of whether or not the market is likely to be trending or in a trading range. And here we are 3 minutes into the second bar, and it's not particularly big. So that is not trending behavior. And for the bulls, you have to wonder if this is going to be a big bull trend. why were the bulls unable to get a gap above the all-time high? So it makes you question the strength of the bulls. For the bulls, they're hoping that this is a high one buy. We had a breakout on 78, a pullback 79, high one. We have an inside bar 81, a high one. And here, bar 2, let's say its high is below the one high, it's another high one. However, this trend is not very strong. Look at the size of this reversal down. And we have a big bull bar and then 2 doji bars. We have a gap up and a bear bar. This is not strongly bullish. Any reversal on the open can lead to a swing trade, but this looks like a trading range open. We're 4 minutes into the second bar, and the bar is small. The first bar is a bear bar. We're above the average price. This is not above average bullishness, and I don't think it's worth paying an above average price. So I'm not going to buy above 2. Looks like we might be in a trading range open. 80% of opens have at least a minor reversal in the first hour. 50% have an abrupt reversal, so you can have a very strong bull trend that immediately reverses into a bear trend, or a very strong bear trend that immediately reverses into a bull trend. This is a high one bull flag, possible low of the day, but 2 small bars, and the rally is not all that strong. So this is not a scalp. It's a possible swing, but I would rather wait until I see 2 consecutive bull bars with one closing near its high and having a reasonably good sized bull body. Trading range type open, right? You have a bear bar on one and a gap up. They bought below the bear bar. And then we have a bull bar on bar 2 and a bull trend, and they sold above the bull bar. So that's trading range trading. Today is an FOMC day, and the announcement comes at 11 o'clock. Whenever there's an FOMC day, it's better to go flat before the announcement, and it's better to not place any trades for the first 10 minutes, because most of the time, probably 70% of the time, immediately after the report, the market goes one way and reverses. So, and it happens very quickly, so you don't have time to think or to analyze. It's better just to wait for 10 minutes and then decide whether to begin trading. When you get an FOMC announcement, I think you have to be open to any possibility. The market can trend, it can enter a trading range and then trend, it can trend and then enter a trading range, it can reverse, it can be a strong trend, it can be a weak trend. I think one important thing is you got to be quick to exit. So if you think it's a trend, and let's say you think it's a bull trend and you get a bear bar, you get out below the bear bar. If you think it's a bear trend and you get a bull bar, get out above the bull bar. You got to get out quickly, because reversals can be abrupt and they can go a long way. All right, let's say we get outside down on 2. Then 2 becomes a sell signal bar, especially if 2, let's say we get outside down on 3, right? Let's say 3 falls below 2, and let's say 3 closes on its low. That would be a sell signal bar, looking for a test down to the moving average at a minimum. Can today be an outside down day after yesterday's outside up day? Normally I'd say no, but we have the FOMC report, and therefore you got to be open to anything. Even though yesterday was a big bull day, big bull reversal, a big day on the daily chart, we could possibly go below yesterday's low after that FOMC report. Okay, I call that an outside bar, but it's not a very good one. Even though the low did not go below the 2 low, it went down to the 2 low. So for me, that's a variation of an outside bar. However, the first 3 bars are relatively small, and they all overlap one another. Bar 3 has a tail below, so not strong selling. So this is a limit order market, not a very good stop order market. Not good to sell below 1, not good to buy above 2, and not particularly good to sell below 3, although the bears now have a small double top. And this would be a second sell signal. First sell signal below 1 for a failed breakout above yesterday's high, and then we're failing again below 3, so that would be a higher probability sell. I'm not taking the sell. If 3 closed on its low, if 3 closed below 2, I would sell below 3. Bulls trying to create a high 2, high 1 above 2, and then high 2 above 4, and the bears have a micro double top. Small breakout mode, you have a small double top, a potential small double bottom. Best choice, wait. Wait until the market starts to trend, or until we get a better buy setup, like an opportunity to buy near the moving average. This is a reasonable sell. I just wanted the bars to be bigger, and I wanted 3 to close on its low. So if it is a bear trend, I'll be entering after it falls below 3. I'll wait to see what we get. Okay, that triggers the sell, but is it immediately going to reverse up into a haiku bull flag? And then do we go up to a new all-time high, or is this the high of the day? Similar to today, gap up, tried to reverse down a second time. Not very bearish, tail like today, yet we trended down for the rest of the day, so it's a credible top. This is not strongly trending, right? It's sideways, but I think it's always in short. We have consecutive bear bars, and one of them closing on its low, plus we have a second reversal down from above yesterday's high. So it's a credible top. And the reason why we're not falling is because it's not high probability. Bulls are still hoping to get a reversal up from around the high of yesterday, around the moving average, around yesterday's close. Remember, we've been trending up strongly, and traders are accustomed to early lows of the day. You know, look at over the past month, how many bars have tails below. Most of those tails were created by a sell-off on the open and then a reversal up. Sometimes the reversal up occurred after an hour or two, like yesterday, but traders have been expecting every sell-off to reverse up, and they've been right on most days. We've had a lot of reversals. Here, an early sell-off, reversed up. Early sell-off, reversed up. Big sell-off, still reversed up. All right, that's one of the hallmarks of a bull trend. You tend to sell off early and you reverse up. Right now, always in short, so right now it's more likely that we're going to go lower. Trying to create a good buy signal bar, 5. They want 5 to close on or near its high for a high 2 bull flag. The bears who sold below 3, their stop is above 3. If 5 closes on its high, they might get on above 5. I would not. I think if you took the sell, your stop is above 3. For a credible buy, the bulls want 5 to close on or near its high. When you have these trading range opens, typically you have both a buy and a sell setup. And we have the sell setup, and the bulls are trying to create the buy setup above 5. So for the bears, yesterday's high, second reversal down, they want to begin a trend down. And for the bulls, they want a high 2. So gap up and a couple legs down, high 1, high 2, and then a bull trend. High 1, high 2, similar to today. We have a low 1, low 2, and a high 1, high 2. So pretty similar to today. Becomes more bullish if we get a big bull bar closing on its high above the prior high. Three consecutive bear bars, good for the bears. 6 ticks down, so you'll have some profit taking, some bears scalping out for 1 point, thinking that the bars are not all that big. Now for the bulls, high 2, bar 6, if they get a bull bar, but with the 3 bear bars, a lot of the bulls will not buy above 6 unless it's a very big bull bar. You have some limit order bulls who bought the 3 low, thinking it was not a very strong sell. So they bought the 3 low, they bought more lower. And they get out, break even at the 3 low. So far, a good bar for the bulls. Always in bears, I would get out above 6 if it closes above its midpoint. And for the bulls, with the 3 bear bars, I would probably wait for a second consecutive bull bar and not buy above 6. Suppose it's only a 1 or 2 tick bull body, then I would not buy. And bears some bears will get out if it's a 1, 2 or 3 tick bear body, a bull body. But if it closes anywhere near its high, 1 tick bull body on the high, I think most of the bears will get out. Bulls, I would wait for 2 bull bars before buying after the 3 bear bars. You see how some 7 o'clock report took place. You see what happened. 6 was a bull bar until the final second, and then at 7 o'clock it collapsed like that. You know, sometimes a bar can be bullish until the final second and then end up bearish, and that's an example. I did sell below 3, and I just exited on the close of 6, right after the close of 6. I was hoping for a swing down, but 6 is a sell climax and down to the moving average, and too much risk of a climactic reversal. 4 consecutive bear bars, I'm not going to buy above 7. Very good bar for the bulls, possible low of the day, but 4 consecutive bear bars. Right now, I'm trapped out. It's still always in short, but I would get out of shorts above a bull bar closing near its high. Two problems with this bar. At first, it's following 4 bear bars, so the probability is not very good for buying. And second, it's a big bar, so if you buy above 7, your stop is below, and your risk is big. So big risk means the risk reward is not good, and low probability, so it's not a very good buy setup, even though it's a possible low of the day. For the bulls, I would not buy above 6, a bear bar. Their buy is above a bull bar, which would be 7. But if 7 closes with more than a 3 or 4 tick tail on top, I would not buy. Theoretically, the bears are still short. They get out 4, 5, or 6 ticks above a bear bar, and they get out 1 tick above a bull bar. And we did not go 4, 5, or 6 ticks above bar 6, so theoretically the bears are still short. Do I go short again below 7? It's a pullback in an early bear trend. I'm not going to. We're still forming higher lows and higher highs, and that's a pretty good sized bounce on bar 7. So even if it closes in the middle, which it did, making it a weaker buy setup, it's still a big enough bounce to make me not willing to sell at the low. I'm willing to sell at the low in a strong bear trend, but when I get a bounce that big, I do not think this is a strong bear trend. Also, the first 5 bars were small, and every bar, for 7 bars, every bar has at least 1 prominent tail. That means at least 1 reversal, and that increases the chances of this being a bear leg in a trading range. And I don't want to be selling at the bottom of a trading range. So right now I'm trapped out. Not a good buy above 7, and for me, not a good sell below 7. We have an outside bar, bar 7, inside bar, bar 8. So this is an IOI, a breakout mode setup. So theoretically, the bears sell below 8, but most will only sell if it closes on its low. And the bulls will buy above 8, but most will buy only if it closes on its high. A lot of trading range trading so far. Consecutive bull bars erases a lot of the bearishness of the 4 bear bars. That tail on the top of bar 8, 4 tick tail, it's not too big relative to the size of the bars, but for me it's too big. So I'll wait to see if 9 closes on its high and possibly buy above 9. We have not gone above a bull bar since the market went always in short. If I were still short, I would get out of shorts above 8. But 8 did not close on its high, so it's not strong enough for me to buy it above 8. Not a good market for stop order traders. Most traders right now, I think, better off flat. Even the bears are sold below 4. With the consecutive bull bars and the bull IOI, I would get out of shorts here. Can you sell again below 9? I would not. We're now in the middle of a tight trading range, bad location for stock entries, and it's a limit order market. Lots of sideways trading. Every bar has prominent tails. Dangerous market for stop order traders. We sold off, we reversed up. But the bulls need to start to get bars closing on their highs. What happens if 9 closes on its high? Then we'd have 3 consecutive bull bars. A high 2 at the moving average, high 1, high 2. That would be a higher probability buy above 9 if it closes on its high. Remember I said that when you have a gap up, a lot of times you get a high 2. A couple legs down, 1 pullback 2. Higher probability to buy above bull bars closing on or near their highs. High 1, high 2, bull bars. High 1, high 2, but not a good buy signal bar. A lot of traders will wait until we start to get bars closing near their highs. 3 consecutive bull bars, high 2 with moving average. I think we're probably back to always in long, but the bars are not closing on their highs, so I am flat. Some bears are still short, stop above 3. I would not be. Traders are starting to think about how the first hour will look. 60-minute chart, a wedge, 1, 2, 3. Bears would like to get a sell signal bar, but a 7-bar bull microchannel, it would not be a very good sell. And the bulls, remember I've been talking about the 60-minute chart, spending a lot of time near the top of the channel. When that happens, there's an increased chance you're going to get a strong breakout above the channel, a bull breakout above the bull channel, and a blow off top. So a strong breakout to the upside and then a reversal down. We might get that on the FOMC report today. Wedge 1, 2, 3, but we've had lots of wedges all the way up, and it's still a small pullback bull trend, spending a lot of time at the top of the channel. So increased chance of a bull breakout and then a reversal down. Bull channel, similar to the 60-minute chart, bull breakout, and then a reversal. Usually if you get a climactic, a blow off top, the bull trend ends and you get a couple legs sideways to down. Here we got 3 legs down. Then the market decides whether to resume up or reverse down. Bull channel, bull breakout above the bull channel, and a reversal down. Bull channel, breakout above, reversal down. A lot of traders will wait for a second sell. Bull channel, you can call it a wedge, 1, 2, 3, or 1, 2, 3, 4. But anyway, we broke above the top of the channel and reversed down. That's a 2-hour chart. Breakout above the bull channel, reversal down. Breakout above the bull channel, bull trend ended. Breakout above the bull channel, reversal down. Sell. Probably buyers below 9. Really difficult to do anything here in the middle of a very tight range. We have a credible buy, a high 2 above 8, but not looking good. And the bears still can argue that they're short below 3. I'm currently flat. What happens if 11 closes on its high? That would be another buy signal. What happens if 11 closes on its low? I still would not sell. 3 consecutive bull bars holding above the moving average. I'm flat right now. This is the final bar of the first hour, so it affects the appearance of the 60-minute chart. The bears were hoping that the rally on 9 was simply a test of the 3 low, and that we're forming a lower high major trend reversal. But 10 did not close on its low. Plus we have those 3 bull bars. So right now I'm trapped out. This is the final minute of the first hour, and the bears are trying to get the hour to close near its low. However, it's still a 7-bar bull microchannel on the 60-minute chart, and that makes it a low probability short below the first hour's low. Good bar for the bears, right? Bar closing near its low. The bears have had a few bars closing near their low today, 4, 5, 6, and now 12. The bulls are hoping 12 is a pullback from the high 2 buy. So high 1 and then high 2 and a pullback. The bears are hoping it's a lower high major trend reversal and the start of a bear trend. Are we back to always in short? I'm currently flat, but if I were doing anything, I would have sold below 12. But a limit order market, very tight range. In general, I don't want to be selling near the bottom. What happens if we get 2 or 3 bear bars? Then it'll be a better sell to close market. 12 bars and 8 bear bodies in the first hour. Not good for the bulls, especially when the market is high. You know, we've been way up. Now we're getting a lot more bear bars than bull bars. Can you buy above 13? If it's a big bull bar, sure. It's a possible pullback from a high 2. So high 1, high 2, breakout, pullback. How big a bull body do the bulls need? They probably need at least a 3-tick bull body. And for the bears, it's a short below 12, but they'll get out above a bull bar 13. Or they'll get out 4 ticks above 12. So if 13 becomes a surprisingly big bar, the bears need to get out at some point. I would get out maybe 4 ticks above 12. Not clear, right? The probabilities are not high for either the bulls or the bears. Limit order market. Reversals, limit order trading. Still breakout mode. For the bulls, this is a pullback from a high 2 bull flag at the moving average. And for the bears, they have a reversal down from above yesterday's high. And they're hoping that we trend down. I am currently flat. It's good for the bulls that we're holding above the moving average. It's good for the bears that they have a micro double top and a failed breakout above yesterday's high. I think best choice here is flat. Better to wait for a better buy or sell setup. You can call it a triangle. 3 tops, 1, 2, possibly 3, and 2 higher lows. You know, why are traders not creating better signal bars? 8, 7, why did they not close on their high? 9, 10, 11, why did they not close on their low? 14, why did it not close on its high? Triangle, breakout mode, 3 highs, 1, 2, 3, so lower highs, higher lows, a tight trading range. The bulls always have a buy setup in a trading range. The bears always have a sell setup. The probability is that the first breakout up or down will reverse 50% of the time. The probability of a successful breakout up or down equal 50% chance of a swing up, 50% chance of a swing down. We're getting near bar 18, and by the close of bar 18, typically 90% chance we've seen either the high or low of the day. When the initial range is small like this, it's probably more like 80% chance. We have a credible high of the day, bar 3. This is not yet a credible low of the day, although it could be the low of the day. The bulls need to start to get bull bars closing on their highs. Small range, so the day's range is probably going to at least double, and it can do it in 3 ways. 1 is break below the low, fall for a measured move down. 2, break above the high, rally for a measured move up. 3, go a little bit below the high or low, and then go through the opposite side. So go a little bit below and then a little bit above. Now, some days are like this where you just have to be patient, and we've had a lot of them lately. You know, very easy to lose money by trading too aggressively too early. You know, for example, yesterday. Sometimes the market just gets into a pattern, a lot of trading range opens. Other times it gets in a pattern with a lot of trend from the open days. But this is, I think, not a good environment for stop entry traders. Limit order traders are doing well. buying below anything, buying below 1, buying below 2, buying below 5, 6, buying below 10, probably profitable, and selling above everything, selling above 3, selling above 8. It's a limit order market. Limit order traders have had many profitable trades. However, I think traders should be looking for stop entries. When the market's in a trend, there are lots of stop entries and very few limit order entries. When there are a lot of limit order entries and very few stop order entries, you know the market's in a trading range. And that's what we have here. For the bears, an early bear trend 12, and then a micro double top 14 and 16, but a bull bar 16, not a good sell. So I think traders are still better off waiting. We're getting near bar 18 when the market typically begins a swing up or down. Sometimes it begins a couple bars before, sometimes a couple bars after, but this is the time window when the market often begins a swing. Yesterday, here's bar 18 closing on its low. We got a swing down. It lasted only a couple bars, but that's when the swing began. Here, we had a bull bar closing on its high, but the two bear bars, most bulls wanted a second buy. And they had a second here, a third here, a fourth here, and then a swing up. This is another potential sell signal, a double top bear flag. Also, we're around bar 18 when the market often begins a swing. So if 17 closes on or near its low, it would be a credible swing sell, not a scalp, right? The probabilities are not good for stop entries. Higher probability, you wait for the breakout and then enter after you see the breakout. So important bar, will it close on or near its low? Swing sell for a double top bear flag. So early bear trend, double top bear flag. You can see the hesitation, right? Everybody knows it's a double top bear flag. What we don't know is if the bulls will create a bear trap. There'll be so many bulls buying that 17 low, trying to trap the bears. Remember, when you're in a triangle, 50% chance the first breakout up or down reverses. So this is, in my mind, a downside breakout, but 50% chance it will reverse. Apex of the triangle, and we're at bar 18 when the market often begins a swing. It's a failed low 2 and a failed breakout attempt below the bottom of the triangle. Do you buy above 18? In general, a tight trading range like this is really not a strong setup. We're still on the sell below 17. Bulls trying to reverse it. Theoretically, the stop for the bears who sold below 17 is above 16. Can you buy on a stop above 16, hoping that it's a breakout and that we go up to the new all-time high? The math is just bad. Whenever you're in a very tight range, the math is bad. I'm currently flat. I did not sell below 17. I was waiting to see what the breakout looked like because of the possibility, 50% possibility, that there would be more bulls than bears below 17. It's still on the sell below 17, stop above 16. Some bears will get out above 18. And for the bulls, 18 did not close on its high. And we're still below the stop for the bears. So if I were anything right now, I'd be short. And I would get out above 18 or above 16. I'm currently flat. This is good for the bulls, right? The bears have a credible sell below 17, yet 19 is breaking above the 16 high, which is where the bears have their stop. So remember, 50% chance when you're in a triangle, if you get a bear breakout, you're going to get a reversal. 18 is the bear breakout and 19 is the reversal. So this is good for the bulls. Bulls either buy at the market, they buy the 16 high, or they wait for 19 to close and buy above 19 if it closes on or near its high. So that is a credible swing buy, stop below 19. We're still arguably in the triangle. Personally, I'm going to wait because this could have been a better setup. 18 could have closed on its high. 19 could have closed on its high. So I'll probably wait for one more bar. Although I think we're currently always in long, and I do think that is a credible buy. 17 was a credible sell, but not good enough for me to take. And 19 is a credible buy. I'm probably going to wait for one more bar. The bears now hope that instead of a low 2, 17 is a wedge. 3 pushes up 14, 16, 19. Remember, my goal is to make money. And sometimes I have lots of opportunities to do it. Other times I do not have many opportunities to do it. Or sometimes I'll wait a couple hours. And I got to make sure that I think the setup looks reasonable for me. Some traders have certain types of setups that they like, and they trade only those setups. Some traders are very flexible, trade everything. Limit orders, market orders, stop orders, swing trades, scalps, which is the way I typically am. But I'm trying to move more towards swing trading as I get older, becoming more selective. So I'm taking fewer limit order trades than I did several years ago. I still take a lot of them, but I'm taking fewer than I used to. Just like there were buyers below 17 when the bears had a low 2 bear flag, there might be buyers below 20. The bears have a wedge bear flag. Bulls have a breakout. 19 closed above 18 high, and the body of 20 does not overlap the body of the breakout point. The breakout point 16 high. So we have a gap there, and that's good for the bulls. That increases the chances that we're beginning a bull trend. I think we're always in long. Probably with the close of bar 9, 3 consecutive bull bars, the bears did not go below the 7 low, and they have consecutive bear bars 12, 13, but it looks like we're trying to reverse up. Because we're always in long, if I were in the market, I'm flat right now, but if I were in the market, I would be long. If the bodies overlap, for example, if the close of 21 falls below the close of 16, then the pullback bar, the body would overlap the breakout bar's body, and we would no longer have a gap. Right now we have a gap, but it's a body gap, the gap between the bodies. The low of 20 overlaps the tail on the top of 16. The bodies do not overlap. That's still a gap, and it's still good for the bulls. So it increases the chances that we're in an early bull trend. Bulls trying to get back above yesterday's high. They're trying to get a breakout. They have a breakout 19. They want a more impressive breakout, maybe 21, 22. 90% of the time, a swing trade begins around bar 18 or earlier. And so traders are wondering, is this the start of a swing trade? No surprise that 4 points above 19 takes us up to the all-time high, which is the obvious magnet for the bulls. Bulls need to get bigger bull bars and consecutive bull bars, 2, 3, 4 bull bars. Even if they're small, that would increase the chances of this going up. For the bears, a double top 9 and a wedge 3 or 4 legs up, or you can call it a small low 4. High 1, low 1, low 2, breakout, low 3, low 4. Will the bulls get out below 22 because of the possibility of a small low 4? If it closes near its low, I think it's probably worth getting out. And for the bears, it's still another lower high. But it's also a small pullback bull trend, small pullback, small pullback. So it's still not yet clearly trending. Bulls, they get out 1 tick below a bear bar, 22, maybe 4 ticks below a bull bar, 21. 1 bar pullback, 15. 1 bar pullback, 18. Bulls need to get this to back up. The bears want to get a 2 bar pullback, a 3 bar pullback, and then they want it to grow into a reversal. The bears want to close below 16. That would close the body gap. And for me, it would end the bull trend. It does not necessarily begin a bear trend, but it ends the bull trend. You know, bull trends, if you're getting gaps and body gaps, you want to see them stay open. If they close, then it's probably not a bull trend anymore. We pulled back below the breakout point, but the bodies did not overlap. The bottom of this body did not overlap the top of any of these bodies, so it's still a body gap. Body gap here as well. The breakout point, the pullback overlapped the breakout point, but the bodies did not overlap. But look what took place here. A pullback, but this body overlapped that body. That tells you that the bull trend might be ending soon, and we went sideways for a couple hours afterwards. We have a gap here, the body gap. The bodies did not overlap, but then this body overlapped the body of the breakout point, and that was the end of the bull trend. We fell below the breakout point, but the bodies did not overlap. And then here, we finally overlapped. This body overlapped the bodies of the breakout point, end of the bull trend. Okay, finally getting an overlap. Here's the breakout point, here's the pullback. We're still open, and then here we closed and ended the bull trend. We have a pullback. The bodies are not overlapping, and then boom, this body overlapped the body of the breakout point here, end of the bull trend. The market still has not yet decided. Are we in a bull trend going up to the all-time high, or are we in a bear channel forming lower highs and then getting a bear breakout? Right now it's slightly more bullish than bearish. We have a body gap, but the bulls need to get consecutive bull bars. You know, bad follow through 20, 21. You understand what's going on, 25. Part of it is bulls bought above 19, disappointed 20, 22. Some of them decided to get out around break even, and they placed a limit order to sell at the 19 high, or they tried to sell at their entry price 1 tick above 19. And that's why 25 pulled back like that. It's weak bulls giving up, disappointed by the bear bars. It's still always in long. They're still walking up the moving average. But so far, not clearly bullish. The bears still have an argument. If we get a big bull bar or 3 or 4 decent bull bars, that would mean the bears are finally giving up, and that will increase the chances that we're going up to the new all-time high here. The bears have not yet given up. They keep selling above everything, above 14, above 16, above 21, a bull bar closing on its high, they sold above it. And they're selling above 22. But if the bulls buy with enough volume here, those bears are going to be forced out, and we'll get a gap for a possible measured move up to above the all-time high. When you look back, where is the first credible buy? Probably the double bottom 18, and therefore traders expect a rally to go 17 or 18 ticks above that bar 18 high. So that would be around the high of the day. This is far enough up for bulls to take 4 points profit. 26 strong enough. Probably we'll get at least a small second leg up, which means we'll probably get the new all-time high. Even though it's bullish, it's not all that strong. We did not have great buy signal bars, 18 or 19 or 25, and the breakout 26 is not all that big. Plus, we've had a lot of trading range trading so far today. I did buy the 19 high, and I just got out within the past couple of minutes, even though it's still bullish. It got to around that 29.55 level, which is where I thought it would get, so I got out there. So now I have to decide what to do. Is this going to be a strong bull trend and a buy the close rally? Will I have to buy again? For the bears, a higher high major trend reversal. A triangle is a common final flag, so we have a bull trend and a triangle. It's a magnet. The market usually comes back to the apex of the triangle at some point later in the day. However, 26, 27, a good enough surprise. Odds favor at least a small second leg up, and therefore I would wait for a second sell signal and not sell below 28. What do the bulls do if 28 closes below its midpoint? I'd get out below a bear bar, and I'd get out 4 ticks, 5 ticks below a bull bar, 27. So if 28 suddenly collapsed down, I'm not going to wait for 28 to close. I'll get out. I'm flat now, but if I were long, I'd get out 4 or 5 ticks below 27. Since it's not a good sell, there will be bulls buying the 27 low. I'm not one of them. Now, if you buy the 27 low, what do you do with 28? It's a problem, right? It's not a strong trend day, and I think it's probably good to get out a tick or two below a bear bar 28, even though we're still always in long, even though the odds are we're going to go up a little bit more. This is not behaving the way a strong bull trend typically behaves. You expect better buy signal bars down here, anywhere through here. You'd expect bigger breakout, and you would not expect a big bear bar 2 bars after the breakout. So this is probably not going to be a big bull trend day. That means it's probably a bull leg, what will end up in a trading range. Plus we have a triangle. So we have a magnet here, and we'll probably come back here. It's possible we come back here now, but I suspect we'll get one more leg sideways, two up. And I do think we'll get back here. It's possible that we do not get back to the apex of the triangle until after the FOMC report. Remember, you have buy the closed bulls 27, disappointed 28. A lot of them will try to get out break even when it gets back to the 27 close, and that often creates a micro double top. The bulls right now, high 128 with a big bear bar, not a strong buy. So most bulls are not going to buy above 28. What happens if 29 is a bull inside bar? It doesn't matter, bull inside bar, bear inside bar. It's a high 1 bull flag, a pullback from the breakout above the high of the day. However, with a big bear bar 28, a lot of the bulls are not going to buy above 29. For the bears, not a good enough sell. And for the bulls, I think not a very good buy setup, but always in long, right? And we have not gone below bear bar, so the always in bulls are still long. We have not gone 4, 5, 6 ticks below a bull bar, so the always in bulls are still long. Now, the buy the close bulls 27, reasonable for them to buy the close. Yet they're trapped. They have not been able to get out, break even. Whenever you do something reasonable, 80% chance you can avoid a loss, especially if you scale in lower. And therefore, if we go down, let's say we just keep going down, 80% chance we'll get back to that 27 close at some point today. One of the problems is it can come right after the FOMC announcement, but most traders should get flat before the FOMC announcement. And therefore, if you buy the close 27 and we start to trade down, you have to get out below the FOMC announcement. Even though 80% chance, we're still going back to that 27 close. 20% chance we're not. And on the FOMC announcement, we could get a plunge down here, right? And you don't want to be long up here and then 1 minute after the announcement, find the market 20 points below your entry with no realistic hope of avoiding a loss. So this is a special situation. Normally, you could buy the 27 close and be confident that before the end of the day, we're going to get there, and you buy more lower. But today, the FOMC meeting, I think you have to be flat going into the meeting. So this is not the usual type of deep pullback from a buy the close situation. Went below bear bar 28. We still have a gap 22. I'm currently back to flat. I got out at bar 27. When does it become always in short? We have 3 bear bars. You know, when I say 3 bear bars, one is a doji. I count it a bear bar. If we have 2 bull bars and a doji, I call it 3 bull bars. But right now, this is 3 bear bars. Bad for the bulls. The bulls who bought that 27 close are trapped. And they're afraid that this is a higher high major trend reversal and a final flag, possible high of the day. We still have a gap 22 high. Not a good looking sell, not a good looking buy, but still always in long. When does it become always in short? A single big bear bar could do it. 3 consecutive actual bear bars, not dojis, that could do it. Right now we're trying to test the apex of the triangle, which is around the 26 Y climax low and around yesterday's high. Yesterday's high, support, resistance, resistance, bulls hoping support. I'm not going to buy above 31. We have 2 decent bear bars, maybe a 3rd bear bar. So probably sellers above 31. And I did not short. We had a second sell signal below 29, the inside bar. Higher high major trend reversal, failed breakout high of the day. Double top with the all-time high back in September. But only a doji bar. Plus those 2 bull bars, 26, 27. Typically, you see at least a small second leg up. That lowers the probability for the bears selling below 29 or 30. So right now, I'm waiting for more information. I'm not going to buy above 31. Too many bear bars. Decent bear bars 28 and 30. I don't want to buy the first reversal up, so I have to wait for the selling to stop, for the market to go sideways for a few bars, and probably wait for a second buy, like this, first and then second, or first and then second. The big tech stocks, Some up, some down. Apple, big gap up and big bull bar so far today. Google, on the other hand, big gap down. Facebook, I think, doing surprisingly well. Tesla, everybody knows that. I think it's something interesting. Everybody knows Tesla is not worth this much money. It's not going to sell enough cars to be worth this much money. However, markets can still go up even if they're overpriced. I remember Amazon, they put up a monthly chart. Amazon had crazy price earnings ratios, and it was not really making any money, but everybody knew it was a great product. So even though the financial statement looked bad, I mean, it looked bad forever all the way up. You know, here we're up tenfold over the past 5 years or so. Tesla is a different situation. You know, the financial statement is bad, and there's no expectation that it's going to sell a whole bunch of cars and justify these prices. Amazon, you know, even though the financial statements were bad, everybody knew it was a great product, and that's what the result is. Becoming always in short, breaking below the bottom of the bull breakout 25, back to the apex of the triangle, back below yesterday's high. But this is a problem. A lot of trading range trading, it makes traders not want to sell too low, and we are low right now. On the monthly chart, it's a perfect double top with the September all-time high. Here's the weekly chart, a perfect double top. Today's high is exactly the same as that high. There were some computers that sold with a limit order at the September high or one tick below, and they had to stop 1 or 2 ticks above. The probability was they'd get stopped out. Whenever you take a trade where you're only risking 2 or 3 ticks, you're probably going to lose money. Anytime your risk is very small, your risk reward is fantastic, and that means you have to have very little chance of making money. That means you probably lose. However, it's still mathematically an okay trade. For example, if you buy a lottery ticket, you pay $1. The most you lose is $1. You can win $1 million. Your risk reward is tremendous. That always means your probability is low. It means you probably lose. And and for the state that sells you the lottery ticket, they're risking $1 million. So their risk is big, and they're willing to give you that $1 million, even though you're only giving them $1. So for you, their reward is small. On any one ticket, they get a reward of $1 and a risk of $1 million. However, the probability of them losing is tiny. So they're willing to sell millions and millions of tickets, and then, in other words, collect millions and millions of dollars, knowing that they're going to pay out $1 million, but they're collecting $2 million or more. So the state has low reward and big risk, but very high probability. So they take the same trade millions of times and they end up making money. And the lottery ticket buyer, very low risk, very high reward, that always means low probability. When you're trading, there's always a trade-off between risk reward and probability. If one side is good, the other side is bad. Sometimes they're both, neutral, but anytime one starts to get good, the other gets bad. So if you see a trade where the probability is getting better and better, the risk reward is getting worse and worse. If you see a trade where the probability is getting less and less, then the risk reward is probably getting better and better. Some traders like great risk reward trades, swing trades, which most traders should take, and the probability, at least initially, is usually only about 40%. But the math is still good, because 40% of the time you'll make twice your reward or twice your risk or more than twice your risk. 60% of the time you'll get small losses or small wins. That is good math. Scalpers, they need really high probability. One way to maintain a high probability is to scale in. So a lot of times the scalper will buy, his premise is still valid, the market goes against him, he'll buy more. So he's increasing his probability, but he's also increasing his risk. Always in short, who's going to buy above 33? Nobody. But if we go sideways for a few bars and get a couple buy setups, traders will start to take a second buy. Can this be a trap? Can it be like yesterday? Bear bar and then bull inside bar, reversal up? Yep. But typically you'd expect at least a micro double bottom. Now I said earlier that we're probably going back to that 27 close today, and that is true. But I also said that we may not get there until after the FOMC report. Bulls, let's say 33 is a bull inside bar, comparable to 21. A bear trap, bull reversal. You could buy above 33. I would wait for a second buy signal or for 2 or 3 bull bars. Yesterday you could buy above 21, or you could wait for a second bull bar. 22 had a tail on top. 23, very small tail, so you could buy above 23 or above 22. By the time you get 23, the odds are you're going higher. Always in short, so traders can sell for any reason. They could sell the market, put a stop above 27. They could sell above bars, above 33, stop above 27. For the bears, higher high, major trend reversal. Bull trend, bear breakout, higher high, major trend reversal. It's also a triangle, late and a bull trend, so a good candidate for a final bull flag. Big gap up, so bull trend, trading range, breakout, the final bull flag. Trading range, late in a bull trend, possible final bull flag. Another one here. Here, it only led to a pause in the bull trend resumed. Sometimes you get triangles. Instead of just trading ranges, sometimes you get a triangle. So gap up, triangle. Here we got a second sell, and we came back to the apex of the triangle. Triangle, you don't know it's a bull trend, but it is a bull trend. And we have a strong bull breakout, apex of the triangle, a magnet. Usually you come back to the apex of the triangle, and then you could go up or down. Here we just kept going down. Tight trading range, late in the bull trend, possible final bull flag. Triangle, final bull flag. Triangle, final bull flag. Small, we have an OO, consecutive outside bars. Sometimes that is the final bull flag. It's giving up. We tested the resistance of the all-time high, and we may get down to the 60-minute moving average. It's sell the close, sell the market, all right? But if you sell, you need a wide stop. Now, what about the chance of the market getting back to that 27 close? I would not buy here with that expectation. The bulls, I think, need to stop the selling, go sideways for several bars, start to create bull bars. Right now, more likely, if we get a rally, let's say about 35, it'll be a minor reversal and will form a lower high. The bears want to get down to the next support, 60-minute moving average. We may get stuck here. The market thought this was a fair price earlier. We went above it. The market decided too expensive. If we go below it, it might decide too cheap. Yesterday, the market thought this was a fair price. We went below it, too cheap, back up to it. And you buy a test of the 7 low, and you buy with the limit order, betting on a sell climax and a reversal up. I would not do it. I'd really be short or flat. And if flat, I'd look to sell the first rally. And the bulls need at least a micro double bottom. Bears get out above a bull bar. There's always a chance of a reversal up like yesterday. Big bear breakout, bull bar. I'd get out above a bull bar. So bears get out above a bull bar. Or they also get out above a bear bar. If it goes 4, 5, 6 ticks above a bear bar, 35, I'd get out. Even though we'll probably get sellers above, and the bulls will probably need a micro double bottom. Still solid close, but a tail, and also 8 consecutive bear bars. We're probably going to get some profit taking soon, so we'll probably bounce here around where we are. Bar 36, a multiple of 12, so it represents the final bar of the 3rd hour. And so far, a micro double top, outside down, and a wedge, 1, 2, 3. So a credible top. I think today's FOMC announcement is going to be especially interesting because of where we are. We have a perfect double top with the September high. So there's a potential for a surprisingly big move. It could be up. We could easily break strongly above the all-time high and end up with a huge bull trend. But because of the location, I think there's an increased chance of a big move, either a strong breakout above the old high or the start of a pullback. Typically, when you test a prior high, you pause. So I'm assuming that we're going to start to go sideways for 2 or 3 weeks. I would get out of shorts above 36. I would not take the buy. Too many bear bars. For the bulls, double bottom, 7, failed breakout, low of the day, and very good bull bar. What's your goal if you buy 36? Are you looking for a rally back up to 27? The bulls will probably need at least a micro double bottom, and therefore it's not a very good swing buy. We'll probably get a second buy later. That means you're left with a scalp. If you buy above 36, stop below 36, you're risking about 3 points. How much money are you trying to make? Are you trying to make 1 point? Well, you're risking 3 points to make 1 point. That means you have to be right 75%, 80% of the time just to break even. And therefore, you can be right 60 to 70% of the time and lose money. So if you win 7 times out of 10 and you make 1 point, you make 7 points. But if you lose 3 points on your 3 loses, you lose 9 points. Therefore, even winning 70% of the time is a losing strategy. That is not high enough probability to go for a 1 point scalp above 36. If we go up now, the bulls have a micro double bottom. Down on 35, up on 36, down on 37, maybe up on 37 or 38. That would be a higher probability buy. but I still think the math is not good enough for a scalp. And for the bears, they'll probably sell around the moving average, yesterday's high, and the apex of the triangle. So what do you do here? Well, I get out of shorts above the bull bar of 36, and aggressive bulls can take the buy, but I think the math is not particularly good. We may come back to yesterday's high. We spent a lot of time around it earlier today. For the bears, inside bar in a bear trend, so it's a low one sell, but it's a big doji, not a good sell signal. Plus it follows a big bull bar, so probably buyers not far below 37. Apex of the triangle, a magnet. It was a magnet when we went above it. Trading range is always a magnet. Yesterday's high was an important price all day. For the bulls, a failed breakout, low of the day, a micro double bottom. We're probably going up at least a little. Can you take it for a swing? I would not, but some traders will take it for a swing. They'll be disappointed by the rally 38 and they'll switch to a scalp. Can you take it for a scalp? I think the math is difficult. Like I said, you can increase your probability by using a wide stop and scaling in, but if you're just buying above 36, putting a stop below 36, trying to get out with 1 point, I think if you do that 10 times, you'll lose money. You may win 7 of the 10, but you'll end up losing money. Now, 37, a bad low one sell. Therefore, there probably are more buyers than sellers at the 37 low and below 36. So limit order bulls will buy, and stop order bulls, I think, will be less interested in buying unless they're willing to use a wide stop and scale in. II, consecutive inside bars, the low one short, but an II late in a bear trend, possible a final bear flag. If we get a reversal of 39 or 40, that would be a higher probability buy than buying above 36. A lot of the bears who sold 38 will scalp because of the possible final flag and because of the support just below. Can you sell to close 39? Nope. It's the biggest bear bar, fairly late in a bear trend, at support and a potential final flag. So I'm not going to sell below 39. What happens if it keeps going down? Well, I'll sell again lower, but I'm not going to sell the 39 close. A big bear bar, late in a bear trend at support, that will attract profit takers. Some of the bears will take profits. I think not a lot of bears are going to sell the close of 39 or 40. You'll get bears looking at this saying, wow, I was not expecting this much profit. We're at support. Yesterday's trading range, 60-minute moving average. Maybe I should buy back my shorts. Not sell the close. Big tail plus big bar at support. II, possible final flag. Consecutive inside bars. It's always some kind of a triangle on a smaller time frame chart. Here's the 1 minute chart. You can call it a triangle with this high, 1, 2, 3. So triangle, late in a bear trend, a magnet. We have a low tick reading, minus 700, the blue line. Typically not the final low in price, but to me this looks like a potential final flag. And that makes me not eager to short. II, late in a bear trend at support. It will attract profit taking. Bears will buy back shorts. A lot of the bears will wait for a couple legs sideways to up to around the moving average before selling again. Now, what about buying above 41, given that we have a potential final flag? Well, it would be a higher probability buy than buying above 36, but it's still probably a minor reversal. So probably sellers around the 38 sell climax high and the moving average. So probably not going to get much higher than this on the first leg up if we go up. Now, let's say we have an inside bar of 40. another low one, just like the II-38, but I would not take the sell. We have a sell climax, possible final flag at support. I would wait for a couple legs up before selling again. Probably more buyers than sellers below 40. I'm sure there were limit order bulls who bought the 37 low, 1 point lower, 2 points lower, and they probably will make money. We're probably going above the 37 low. So what I'm describing is profit taking and a minor reversal and a trading range over the next several bars. Bears get out above any bull bar. A bull bar closing near its high, you'll probably get some bulls buying. They want to swing up, but they'll probably end up scalping because we probably will not race up. If it has a 3-tick tail, most bulls will wait. Not a very good looking buy signal bar. For the bears, it's a low one short, not a very good sell signal bar. So we may be into a limit order market. We should get back up to the moving average. I was going to buy above 40 for a scalp if it closed on its high, but it did not. It's still probably an okay buy if you can use a wide stop. But if I'm buying in a bear trend, I want the buy signal bars to look very good. Trap bulls, will they get out below 40, 39? Most of the bulls who bought above 40 are experienced traders, and they knew it was a weak buy. When they take a weak buy, they use a wide stop and they scale in lower. So most of those bulls who bought above 40 will buy more, 1 point down, 2 points down, or below 40 or below 39. What happens if we get a bear bar closing on its low, 41? Well, it's a low one short in a bear trend, but a pretty big bounce, 39 low at support and a possible final flag. And to me, that's not a very good short. I think there probably are more buyers than sellers below 40 and 39. Are we back to always in long yet? No, but we're probably in a bull leg in a trading range. Should get to the moving average into the 36 high. Most bears will want at least a couple legs sideways to up before selling. Can this be a bear channel with bears selling big bull bars at the moving average? Probably not. Normally you don't have such a long spike, plus we have this final flag. So more likely we'll get some kind of a trading range instead of a test of the moving average to new low, test of the moving average to new low. So what happened? Well, some kind of 10 o'clock news. A lot of times you get bond announcements at 10 o'clock. I did not check to see if there was one. I'm going to check on my other computer. No, I don't see anything other than FOMC at 11. Are we always in long? Depends on how the bar closes. If it closes near its high, then yes. If it closes around the moving average, then I think we're left with confusion and a trading range likely. Just the size of the reversal is enough for it to be always in long for a lot of traders. Let me look at ticks. We did this final low, this extreme low in ticks was not the final low in, it was the final low in price. Sometimes it is. Usually you get a tick extreme, it's not the final low in price. But when a day has a lot of trading range trading, like today, there's a higher chance that ticks are less reliable. Just like everything else. Anytime you see a big bull bar, you got to be thinking reversal down. Every time you see a big bear bar, you got to be thinking reversal up. So big bear reversed up, big bull reversed down. And the same is true with everything. Trend trading type things tend to reverse. Ticks, that's a bet on the continuation of a trend. When the market has a lot of trading and is trading, anything that has to do with trends is less reliable. Big enough reversal up, most bears are not going to sell below 43. We're probably always in long. Probably we'll get a second leg sideways to up. But that big tail, I think, creates a problem. Bulls will not buy the close 43, and bears, the size of the reversal is big. Bears will not sell below 43, so we're probably going to go sideways pretty soon. We're probably always in long just by the size of the reversal, but it might be a limit order market. You can see we got back to the apex of the triangle and back to yesterday's high, which has been support and resistance all day. I did not buy the 40 high. During 41, I placed a stop order to buy at the 40 high, so in other words, a second buy, and I pulled my order before I could fill, so I missed this buy. Is it still always in long? Yeah, I think so. So probably more buyers than sellers, 43 low. But confusion, big down, big up, big down, big confusion usually results in trading range trading. A lot of limit order trading. Where do these bulls put their stop? They probably initially have a stop below 39. Some will buy more 39 low. What about the bears? Do they sell below 43? Well, the bears get out above 40. They want to sell again below a bear bar closing on its low, not 44. If we get 3 bear bars, they might sell. But even then, I think most bears will want a second sell, a micro double top, a low 2. We may end up just going sideways into the report at 11. So possibly limit order market. 40, not a good looking buy. So some bears sold more higher. They had to use a very wide stop, but they made money. 41, 43, not a very good looking sell. So bulls will buy it and buy it lower using a wide stop, expecting it to get back above the 43 low. Not good enough for a scalp. Looks like confusion, down and up and down and up. Can you sell here? I think we're always in long, so I would not sell. What happens if you get a bear inside bar 46? That would be a second sell signal, low 1, low 2. I would not take it. I think traders are either long or flat, but I think it's mostly limit order scalping. Selling above 40, scaling in, buying below 43, scaling in, and then getting out break even. On one other point, someone just reminded me of, we have this ledge, yesterday's low, 4 bars, same price here, and that's always a magnet. So some of the bears who sold here or here sold expecting to break out below the ledge, and we have not broken below it. We're testing it. In general, if you have a ledge, 80% chance you'll go below it and back above it either that day or the next day. Here we had a ledge top, 80% chance we'd go above it and then back below it by the next day. And we broke above the ledge yesterday, and we pulled back below its high yesterday, and we pulled back below its high again today. And we have not broken below the bottom of the ledge. It's possible that the market might wait for the FOMC report. I think it's still always in long, but I think difficult to do anything. We may have to wait until after the report. Market getting very quiet, and it's easy to get trapped into a position. You take a buy, you take a sell, and the market just goes sideways into the report. And you have to get out before the report. With these FOMC reports, I think it's really important to be open to anything, trends, reversals, everything. Bear trend, we gapped up. This is an important point. I would say 70% of the time, right on the report, you get a breakout up or down, and it's the wrong way. Here we got both down and up. And because of that, I would not trade until after the second bar at the earliest. Here we got tried to go up, we got a micro double top, we went down. You could buy above that bull bar. I would not, because the first bar had a bear body. And for the bear's micro double top, sell, but it's really not a great sell, right? To me, it looks like a confused market. A lot of times it's tough. Sometimes it's more clear. Here, we had an expanding triangle into the report. Maybe sell below the moving average here. Then we got a double top bear flag, and then we got a trend down. So that was decent selling. Sometimes you get this kind of thing, a huge bull bar. Next bar, not a bear body, and that's important. The absence of the bear body makes it always in long. And I would start buying above that, and then we got a bunch of low ones. I prefer to buy above bull bars closing near their highs. There were many buys. Another example, sold off sharply. That's a 10-point sell-off, right? And if you sold on the report, you would have lost a lot of money. Better to wait for a couple bars, and if they're bull trend bars, then you start looking to buy, like above bull bars closing near their highs. These strong trends, I would say 20% of the time, 80% of the time, you get at least some kind of a reversal. Very big bull bar, bad follow through. You could buy here, micro double bottom, or here, another buy. And then you get a wedge top up there. Huge bull bar. First we went down, then we went up. You could buy that, disappointing follow through bar. Then you could buy above that, or a high 2 here. And even with that, we still got a reversal late in the day. So it's tricky. You want the trend to go one way, up or down, but that is the exception. Here we got a bull bar and a follow through bar, probably going higher. Lots of tails, so trading range. Here we got a higher low pullback. You could either buy that, 3 bear bars. You could wait for a second or third bull bar, and then start to buy above bull bars. We went up, we went down, and then we went sideways, and then a high 2. The bulls got a little bit higher. A rally on the FOMC, a bull II, reasonable buy, but then we have a big outside down, possible final flag, micro double top. Traders will start to sell, either take the first sell or a second, and then sell below bear bars. Big bull bar, weak follow through, but then a micro double bottom, bulls buy above that, and then we got a second sell. Here it's below bull bar, buyers below, but now we got a bear bar and a possible small wedge. This is a mess, just lots and lots of reversals. Small wedge, double top. Big bear bar, but bad follow through. Micro double bottom, bulls would buy that. I think a tough short below that, but you have to be thinking about selling below bear bars. Here we went up, we went down, we went up again, right? You got to be open to anything, and do not hold on to positions. So if you sell and you get a bull bar, you get out. A second buy, all with big tails, so buying pressure. This is still on the buy above 45, but this close to the FOMC report, and with the tight trading range, I think it's better to be flat. remember, we're still trying to get above the all-time high. And I think 50-50 chance we'll get above it today on the report. Right now, we're still on the buy above 45. I'm flat. Everybody assumes the report is going to show nothing, that the Fed is not going to do anything, and that they'll keep waiting and watching. So it's not going to be a surprise. Yet we're probably going to get a big move on the report. Why is that? The absence of a surprise is you just don't know. Some computers will feel the market is overbought, and the absence of a surprise, they'll sell it off. Other computers feel that we're going to break strongly above the high, and if they don't hear anything negative in the report, they'll buy. So that absence can be a trigger for buyers and sellers. Traders are waiting for the report to see if there's some surprise. If there's no surprise, then the bears will sell and the bulls will buy. We just don't know which side has more dollars, and we'll find out on the report. With all of the trading range trading that we've had lately, I think that probably increases the chances that we'll get reversals on the report, but potential for a very big move up or down. We're right at a major price, the high from the all-time high. We're right at it. If we go down, probably minor reversal. Even if we come all the way down here 2 months from now, we'll still probably come back up here later. By the way, I always totally ignore what the people on TV say. For the most part, they're idiots. They're put on TV to sell commercials. Their purpose is to attract eyeballs, and that allows the networks to charge more. But in any given instance, there is about the same number of bulls as bears, and they're only going to put one on, a bull or a bear. So to make a conclusion based upon some guy who looks like a professor is foolish, because there's another professor who believes the exact opposite, and you're not hearing that guy, you're only hearing one side. The market cannot hide what it's doing. If the market thinks the report is bullish, we'll go up and we can buy higher. If they think it's bearish, it'll go down and we can sell lower. I think it's a mistake to be in a position right now before the report. I think it's a mistake to enter within the first 10 minutes. And I think it's a terrible mistake to listen to what anybody on TV says. Looks bullish, right? But probably 70% of the time you get a reversal in the first couple minutes. There, see, right? It was bullish, and now what happened? Right, so 70% of the time that big bull bar reverses, which it just did. So what if you bought the market at the high of 55? You probably panicked out and lost 4 or 5 points. Better to wait for at least 2 bars before trading. Can you trade the 1 minute chart? Risk less? Nope. Here's the 1 minute chart. We were a bull bar, we were a bear bar, and now it finished as a doji. So there's just as much risk trading that chart. Better to wait for at least 10 minutes, and if we get 3 or 4 dojis, you wait 15, 20 minutes. You wait until you start to get trend bars, especially a couple trend bars in one direction. Still always in long since 42 or 43, but I think of the day as starting over when the report comes out. So to me, the day just started, or at least the second half of the day just started with 55. Bull bar so far, but what kind of follow through? In general, I would say 90% of the time I do not trade until after the close of the second bar. Let's say this bar is a big bear bar closing on its low. Can you short it? I would not. I would wait for consecutive bear bars. Let's say it's a big bear bar closing on its low. Can you buy below its low? You probably can, but I would not. Let's say it's a bull bar closing on its high. Can you buy above? Only if you can risk all the way down here. So, you need probably a $25,000 account to buy above 57. In general, traders risk, or should risk, day traders should risk 1 to 2% on any trade. When traders start out, their account is small, and they often have to risk 3%. And if you're risking 10 points, $500, that means you need at least a $15,000 to $20,000 account to take a trade. And it's okay to wait, right? In general, trading after an FOMC report is difficult. You got to be quick. You got to make really quick decisions. But sometimes you get great trends. 20% of the time you get really good trends. 80% of the time you get at least one fairly major reversal. So it can trend up, for an hour or so, and then it can trend down or get a very deep pullback. This would be a good time for trading micro E-minis when they come out next week, for example, because then you could buy above 56 if 56 is a bull bar, and putting a stop below 55 would not be a problem. So instead of risking $500, you'd be risking $50. Can you sell right here and put a stop above the all-time high? I would not. Remember I said we'd probably get back to the close of 27 by the end of the day, but it might happen after the FOMC report. Well, that's what's going on right here. The bears who sold 27 are selling again at the all-time high. Can you short below 56? I would not. If it's a huge bear bar, maybe, but that's not likely. Can you buy above 56? Well, it's tricky. If it's a bull bar, especially if it closes near its high, we are always in long. And consecutive bull bars on the report typically have follow through. The problem the bulls have if they buy above 56 is they're risking $500 per contract. So most traders have to wait. Every tick matters. And that one tick bear body is enough to discourage bulls. One tick bear body is enough to discourage bulls from buying above 56. It's not enough to encourage bears to sell. Sorry about my voice. Not a good sell. Bulls need a high one on 57 or 58. They need a bull bar closing near its high. What happens if we get 3 or 4 bear bars like this? Then traders will start selling. Let's say we get a high 157 with a bull bar closing near its high. Credible swing buy. One of the problems you have is we may get a couple legs sideways to down, and therefore putting a stop below 57, protective stop below 57, is not ideal. Sometimes you get a couple legs in the pullbacks, and the first pullback is not the end. So, for example, if you bought above this bull bar and put a stop here, you would have been stopped out. So if you take that buy, the stop is down here. A lot of times you get 2-legged pullbacks, 1 pullback, 2. So if you buy above that and put a stop below, you're going to get stopped out, yet the buy is still reasonable. Bears need to get 2 or 3 decent bear bars to make bulls conclude that the double top is going to be the high of the day. Things can happen quickly, bear bar, but it could still end up being a bull bar. I don't know if you remember back there at bar, I think it was bar 4. It was a bull bar until the final 2 seconds. and it suddenly became a bear bar. Maybe that was bar 6. It was a bull bar, and then in the final second, it became a huge bear bar. High 1, but 2 bear bars. I would not buy above 57. For the bears, double top, but a doji, and then a big tail 57, so I would not sell below 57. We're always in long. That means chances are we're going higher, and that means chances are we're going to go to a new all-time high today. If we go up here and reverse, expanding triangle, 1, 2, 3. Remember, the odds are, even if we go up, we're going to get at least a decent minor reversal at some point. Only 20% of the time do you get a strong trend that lasts until the end of the day. Bulls trying to get a high 158, but stop is difficult. You still need that wide stop. Sometimes in a situation like this, you'll get traders using a tighter stop, like below 57. One way to do it is you buy above 58 if it closes nearest high, but trade only a half size position, and then get stopped out below 57. And then if you get a high 2, a bar or 2 later, trade a full size on that second buy. That's basically the equivalent of buying above 57 and buying more on the second buy. But you don't want your position to be too big on that second buy. If you have the ability to trade half size on the first buy, that would help. That's the buy, right? But big risk. So if you have a small account, you have to wait. For the bears, a micro double top, 56, 58, but a bull bar, 58, not a good sell. They're trying to get a second sell with a better sell signal bar, 59. If 59 were to close on its low, that would be a higher probability sell than 56. Right now, it's a buy above 58, not strong. Alternative, you could buy above 56. And then the other alternative is to wait to see what the breakout looks like. And if it looks strong, then buy closes or buy above bars. We're always in long, so at this second, the odds are we're going to get the breakout. But the odds will shift if 59 closes on its low. It then would be a credible sell signal. Still always in long, and despite the second sell signal, it has a big tail, so not a high probability sell. For the bulls, it's still a buy above 58 and above 56. The market's deciding, are we going to break to the new all-time high or pull back for a few weeks? So this is important, what's going on here. Bears want a decent sell signal bar. They want a bar closing on its low. And the bulls, they're long, another buy above 58, another buy above 56 if it gets to the new high. Bar 60, a multiple of 12, corresponds to the close of the 60-minute bar. And so far, it's a bull bar near its high, and we have a trend line above. We have a wedge top already, 1, 2, 3. The bears would like to get a reversal. They had one reversal attempt here. They would be happy to get a second one. So they need the next hour to be a bear bar closing near its low to create a credible sell signal. Bears trying to get a bear bar closing near its low. A little bit tricky because it's still long theoretically as long as it stays above the 57 low. So bears selling below the outside down, they're selling into bulls who are still long. So swing sell below 60 if it closes near its low. And bulls trying to get a double bottom, 57. Bulls, I would get out below 57, and bears will either sell below 60 or below 57, or they'll wait for 61 to close and then sell. bulls now hoping for a high 2. Remember I said that we could get fall below and then reverse up a second time. But they need a good buy signal bar of 61. Still not clear. Still slightly more bullish than bearish. But if the bears get a big bear bar of 61, that could make it bearish. The bears, if they sell below 61, they have the risk problem. Stop is far above. And if it has a 3 or 4 tick tail, most bears will not sell below 61. We're getting a breakout, so chances are we're going to go lower. Deep enough pullback to discourage bulls from buying, but if it closes a point or two off the low, bears will not sell. We'll be stuck in a trading range. Big bumps, that is not what you want to see if you're hoping for a bear trend. So not a very good sell to close bar. Are we always in short yet? A lot of the bears will want one more bear bar after that big tail. So in other words, we're still always in long. And the bulls to buy above 62, high to 58, they'll need a pretty good bull bar to undo the damage from those 3 bear bars. On some smaller time frame, possible wedge high or low, 3 pushes down, 1 pullback, 2 pullback, 3, and it's a higher low. So this whole thing could be a bull flag from this bull trend. To buy above 62, I think you need a strong bull bar to undo that damage. If it's not a strong bull bar, you wait. And for the bears, it's not yet sell to close, and it's not yet always in short. However, if 62 closes on its low, then we're probably always in short. You can see the market is still not sure. We're still waiting for clarity. Are we going to get above the all-time high, or are we reversing down for the next 2 to 3 weeks? It's still not clear. We're not having sustained moves up or down. We're alternating every couple bars in very prominent tails up and down. I would not sell below 55. This could still be a deep pullback from 55. Sometimes the pullback goes below the bottom of the breakout. Strong reversal up, deep sell-off to a new low, but I view this as simply a pullback from this, even though it went below the bottom of the bull trend. Pretty common. Here we have a strong rally and a deep pullback to below the bottom of the bull trend. Same thing, strong reversal. I view this as a bull flag from this bull trend, even though we fell below the bottom of the bull trend. Very good for the bears. We bounced at the 60-minute moving average 39, so we'd expect some buyers there. The problem is the obvious one. The bars are big, and therefore the stop is far, and that makes the risk big. Remember we had that ledge yesterday, and we broke below it. For the bears, it's a sell, but only if you can risk that much. If you cannot take that risk, you cannot take that short. Not really an expanding triangle. This did not go above that, but it's almost an expanding triangle. Can you buy above 63 if it's a bull bar? Failed breakout low of the day. Wedge 7, 39. If it's a dramatic bull bar, 2 or 3 point tall bull body, I think you can buy. But if it's anything less than a really spectacular bull bar, I would not buy. And for the bears, I would get out of shorts above any bull bar. And the bars are big, so if you're getting out above a bear bar, I probably would get out maybe 2 points above a bear bar. So 1 tick above a bull bar, 2 points above a bear bar. Remember, when you have a ledge, 80% chance you're going below it, and 80% chance you'll pull back above it. Not necessarily on the next bar, but usually within several bars, sometimes 5 or 10 bars, you'll get a pullback above the bottom of the ledge. Back above the bottom of yesterday's ledge. I would definitely get out of shorts above 63 if it closes near its high. And bulls, can they buy? The issue is the same one, right? Big bar, big risk. And the probability is not particularly good after such a big sell-off. So if it closes on its high, it's a swing buy, looking to get back somewhere in the middle of the day's range. If it has a 4 or 5 tick tail on top, a conspicuous tail, better to wait for a second consecutive bull bar or a second buy signal. Bulls swing by, hoping that this is the low of the day and that we do not continue down. They want to get above the all-time high. There's still time to get there today, although it's not likely after this big sell-off. And for the bears, I'd get out above 63. The bears are still short, and they're hoping that we break below 63 instead of above 63. 63 is a pullback in a bear trend, and therefore it's a low one sell signal bar. But that's a pretty big bounce, and it's a sign of reasonably strong bulls that will make a lot of bears not sell below 63 or 64. 60-minute chart, we have the second sell. The first was either below this bull bar or that outside down bar, and the second is below this bull bar. That's not a good looking sell. And typically, if you get a bad looking sell, there'll be limit order bulls who buy that low and buy more lower, expecting the market to bounce back above that low. And the low of the last hour is the 55 low. So that is a target for a bounce. Low one, but very big bull bar, 63. Most bears, I think, are not going to short below 64. There might even be more buyers than sellers there after this big reversal. Still confused, but the bears should not have allowed that big bull bar, and they should not have allowed that reversal, and they should not have allowed bulls to make money buying the 64 low. Are we always in long yet? Depends on what this bar looks like. If it closes near its high, then yes. If it closes somewhere in the middle, traders will have to wait. Remember, we should get above the 55 low, because that's the low of the last hour, and it's not a good sell signal bar. So bulls bought that 55 low and bought more lower. That's the minimum target, 1 tick above the 55 low. So those scale-in bulls bought more lower, and that allows them to get out break even on their first buy with a profit on their lower buy. We still might get to a new all-time high today, although with this much sell-off, I think we probably will not. There's still an hour left. The bears want a low 2, low 1, low 2. Remember I said that the bears would not sell below 64. They would want a second sell signal, and they potentially get it with 66. Would I sell it? No, this is too big a reversal up. So I'll wait for maybe a second sell signal. Can the bears get a big body closing on its low for a credible low 2? Can the bulls prevent that? Can the bulls get a bull body? That would increase the chances of the market trying to go up to the all-time high. I did buy above 63, but I'm not going to sell below 66. It's tempting, but the bounce is so big that it makes me think trading range is more likely than bear flag, and I don't want to be selling too low in a trading range. Well, it's tough for me not to sell below 66 if it closes on its low, but I'm going to let it go. too big of a bounce. Very big bear bar, very big bars today, bull and bear. I still think trading range is more likely than bear trend. We've been getting all kinds of reversals, big reversals, you know, big up here, down, big up here, down, big up, down. So I suspect that we're not going to get a huge bear trend day out of this. Traders are taking quick profits. They buy above 63. Instead of trying to scalp for 1 point, they'll try to scalp for 2, 3, or 4 points. And the same with selling below 66. Instead of swing trading, a lot of the bears are scalping for 2, 3, 4 points. And that's why we're getting the abrupt reversals. The market goes 2, 3, 4 points. Traders take profits, and the market goes the other way. And the traders, so if you're a bull, you're going to take profits 2 points up, 3 points up. The bears know that, and they'll start to sell 2 or 3 points up. So it's a big version of a regular day. Regular day, you get a lot of bull scalpers at 1 point or bear scalpers at 1 point. And then if you're a bull scalper, the bears do the opposite. If you're a bear scalper, the bulls do the opposite. But here the bars are big. So instead of the reversals coming 1 or 2 points, they're coming 2 or 3 points above and below bars. Bulls trying to get a double bottom. We have a double top, double top up here, trying to get a double bottom down here. It looks like the market is not giving up on the all-time high. So it looks like the bulls are still hoping to get there this week. If the bar closes on its high, it's another buy setup. If it does not close on its high, if it has a 4 or 5 tick tail on top, a lot of the bulls will wait. And for the bears, it looks like they scalped, which was likely. Well, I bought above 63, closed near the high. I was going to buy above 68, but that big tail is enough to make me let somebody else make that profit, so I'll wait. Not enough traders willing to buy too high up in a developing trading range. Probably buyers below 70 for the bears to double top. 66, the bulls have a double bottom, bears have a double top. The result is a trading range and limit order trading. My rules is I rarely take limit order trades in the final hour, especially against the trend. The trend right now is down, and we have a double top bear flag. I did not sell below 70, but I also did not buy. Right now I'm trapped out. I prefer good signal bars like 63 and 66, and not bad signal bars like 68 and 70. Very good bear bar, double top, but you're selling at the bottom of a trading range. And with these big bull bars and these big tails, I don't want to be selling at the low. Bulls again trying to get a good buy signal bar. This, if it looks like that, it's a reasonable buy, but the bounce will probably be minor. We're in our trading range. So far, the day is closing near its low. So for the bears, it's a sell signal, small wedge, 1, 2, 3, and a big double top. And the more the bears can get it to close on its low, the more likely it'll be the start of a swing down. But I think any sell-off will be minor. You know, we may come down to this gap over the next several weeks, but when you have a tight bull channel like that and a tight bull channel like this, it's unlikely to lead to a bear trend. Bulls need 72 to close on or near its high for bulls to buy above it. Not good enough for the bulls. Does it sell to close? Not really. You know, we're right at the bottom of a trading range. You need to be confident that we've broken below the range, and So far, 72 is not enough. Bad follow through after the bear bars. 62, 67, 71 makes traders hesitant to sell too low. Do you remember earlier in the day I said yesterday was an outside up day, and today could be an outside down day? We went above yesterday's high, and it's possible that we go below yesterday's low. I said it was unlikely. I still think it's unlikely. However, we have a double top, a neckline, and the measure move down takes us close to that. I think difficult to short here. Your stop is about 71, and you're not going to let that stop get hit. But with the reversals that we've had here and here, it reduces the probability for bears selling closes down here. Still possible that today becomes the second consecutive outside day. That would create a better sell signal bar for tomorrow. Right now, if today closes near the low, it's a sell signal bar for tomorrow. Can you buy above 74? You need, I think, a very strong bull bar. Whenever you get these double tops, any kind of a double top, and you break below the neckline, I think it's often very difficult to hold short because that second high is often very strong. Bulls are buying, and that makes them look to buy every time we go to a new low. And the result is you keep getting strong reversals, even though the market continues to work down to its target. It's hard to hold short when you get strong reversals like that. And you have to keep selling again, like below 66. I did not sell below 71, but theoretically that's what you do. That's what you do if you're swing trading. Bears, I'd get out above any bull bar. And for the bulls, different ways to draw it. We have a wedge here, now we have another wedge here. Two legs down, one pullback, two, similar to what we had a few days ago. Over here, one pullback, two, very big bear legs. The bulls still got reversal. They needed a micro double bottom, and they needed a couple bars closing near their highs. Still solid close, but I think very difficult to sell this far down when the follow through has been so bad. I forgot to put in the open of the week. The bears want the week to close below the open, and the bulls want the week to close above the open. I do think it's fascinating that we may go upside down, even though yesterday was a big day. So possible consecutive upside down. You know, it looks like We only have 20 minutes left, and that's a lot of points for 20 minutes. Well, 20 minutes, you could say a half hour, 1:15. But, yesterday we get that pop at the end of the day. It's possible that we get a pop down. Odds are against it. Bears, I'd get out maybe 5, 6, 7 ticks above any bar. But right now we're still in the swing down. We have a possible gap, 74 high and 71 low. Double top, neckline, measure move down. Double top, neckline, possibly all the way down to yesterday's low, but I think it's hard to hold short. The risk is big and the probability is not all that great. I think it's fascinating. I'm currently flat, but I do think the bears are trying hard to get a second consecutive outside bar, and that's a sell signal. If you get an 00 in a bull trend, it's a sell signal. Consecutive outside bars in a bull trend is a sell signal. This bar is outside, this bar is outside that. Bull trend, consecutive outside bars, sell. Even though this bar is exactly at that bar's high, I still call it an outside bar because the low is below that low. Bull trend, consecutive outside bars, sell. Consecutive outside bars. Consecutive outside bars. Here, just got a couple legs sideways to down, but it was still a sell. You've probably heard me say many times that consecutive inside bars, II, is a triangle on a small time frame chart. Well, consecutive outside bars is an expanding triangle on a smaller time frame chart. Let me put up a 15-minute chart here. So if we go below yesterday's low, it's probably an expanding triangle top. Different ways to look at it. 1, 2, 3, 4, 5, and then here. But that's how I think of it. I think of it as an II as a triangle and consecutive outside bars as an expanding triangle. It's still solid close. There's yesterday's low coming into view. An important point when you have these attempts to go outside down. Sometimes the market tries to go upside down, but fails to go all the way there. Yesterday, for example, it tried to go outside up and it failed, right? So here, yesterday's high, yesterday's low, went above it, and look what happened when we got just above yesterday's low, reversed up violently. Sold off from above yesterday's high, could not get below yesterday's low. Here, collapsed after going above yesterday's high, reversing down, could not become an outside down day. Bulls bought right above yesterday's low. Sometimes they'll buy right at the tick. Same thing here. Yesterday's high, yesterday's low. A lot of times here, exactly at the low. Yesterday's high, reversed down from above it. We got exactly to yesterday's low and it reversed up. That sometimes happens. Yesterday I called it an outside day, but I also mentioned that its high was exactly at the high of the prior day. So it's not really a full outside day. However, it's close enough. It's a variation of an outside day. Anyway, the risk of selling here is that sometimes the market gets to within a tick or two and then reverses up violently. Profit taking. Bulls deciding that not enough buyers to get above the all-time high. So a lot of the bulls are taking profits. And bears are selling as well, but every reversal begins with profit taking. Outside down day, right? Traded above yesterday's high and then below yesterday's low. That makes today a credible sell signal bar for tomorrow. Can tomorrow be an inside day, forming an IOI and a buy setup? Yep, but right now it's more likely that tomorrow will trade below today's low and trigger the sell setup, and we'll probably start to go down for 2 to 3 weeks. I think it's a fascinating day. Weekly chart, an exact measured move, an exact double top to the tick. We had a top here, we broke to the upside, and we got a buy climax pause, second buy climax, similar to this buy climax pause, second buy climax. I think we're going to fill this gap, probably in the next month or so. However, no matter how strongly down we go, the bulls will buy the sell-off. On a weekly chart, we're trying to get a sell signal bar. We still have 2 days left to the week, and it may not look like a sell signal bar. It still could be a bull bar at the end of the week. And daily chart, consecutive outside bars, you can call a wedge, 1, 2, 3. We have a breakout point. We should test that. And then we have a gap just below. We should test that. So over the next few weeks, I think we'll probably come down here, maybe to this low. Less likely we'll sell off sharply and correct 50%. I don't think we'll do that. I think more likely this is a bull leg in a trading range, and then we'll get a bear leg in the trading range, and the bottom of the range will be somewhere in this general area. Remember, you hear the phrase sell in May and go away. Well, it's May and they're selling, and they may not come back until the end of June. Really fascinating day. It was 2 different days, the day before the FOMC report and then afterwards. On the open, we broke above yesterday's high and reversed down with a tail. And then we had an outside down bar on 3, so that was a better sell, but we still had a tail on 3 as well. And then 4 or 5 had tails, and then we collapsed on 6, but down to the moving average and around a 50% correction. It was a gift, and a lot of the bulls used it to take, a lot of the bears used it to take profits. And then we had an IOI on 8, 2 bull bars, but tails on top, following 4 bear bars, probably a lower high. The bears had a lower high on 10, but after the 3 bull bars, we were probably always in long. We got a higher low here. We have a double bottom, 15, 18. A bull bar, but not quite closing on its high, but it's a credible buy. The bears had a double top, bear flag 14, 16 with a bear bar here. Okay, sell. And it's a triangle with lower highs, higher lows, and a tight trading range. The bears who took the sell, 17, had to exit above 16 or 18, and the bulls who did not take the sell were waiting to buy the failed breakout, 18. And they could buy again above 19 on the breakout. We got to close above 16, possibly measure move up. We got a breakout 26, 27, but we're right at the all-time high. There are always going to be some bear institutions with limit orders selling exactly at that high and a tick below. And there were. I would not sell below 27, but then the bears got a second sell below 29, and then a better one below 30. Then we had a sell to close bear trend, a bear II 38, but late in a bear trend, probably a final flag. We have a bull inside bar 40. I think the bears get out, and bulls would either buy above 40 or above 42, but then it's probably a minor reversal after this very tight channel. And then we're getting close to the time of the FOMC announcement. It's a buy above 45, a pullback from the reversal up. And the FOMC report on 54, 55, it rallied, it sold off, and it rallied again. But bad follow through 56, 57. You could argue a pullback 58, possible buy. Not all that good, better to buy above the all-time high. And the bears got a micro double top, 60, 58, a bigger double top with 56, and a bigger double top with 28. And then on the daily chart, weekly chart, double top with the September high. Bears sold below 60 outside down. 61 did not close on its low, so not good sell to close. 62 closed on its low, so theoretically sell to close, but it's such a big bar, it will attract buyers at the bottom of a trading. The bulls got a pretty good reversal. 63, well, it's possible it's the low today. 62 is so big, the bulls will probably need a second buy, and therefore it's a minor reversal. For the bears, the low 266, but the rally was so big, it's probably a minor reversal down. The bulls 68, a micro double bottom 67, double bottom 61, but did not close on its high. And I said that was a problem for the bulls. The bears have a double top 70, 66, but 3 bull bars, that's a tough short. The short is below a bear bar 71, but swing only. You're selling at the bottom of a trading range where we've had pretty good bull bars. 72, the absence of a bull body, so increases the chances of lower prices. 74, a pause. It's sell to close, but it's not ideal. Doji 74, Doji 75. Big bear breakout 76. Probably going to test yesterday's low, try to get outside down, which we did. And the day ended up as an outside down day. Always in traders, the first trade that I would take, the first trade I did take, was sell below 3. I'd get out of shorts below 8, but I think we're still always in short, maybe always in long by the close of 9. And I would not sell below 10, even though a lower high double top. And for the bulls, for the bears, they might sell below 17. If they do, they get out above 18 or 16. Bulls buy above 19. I'd get out below a bear bar 28. Bears would start selling below the the second sell 29. Bears sell below 30. Bears get out, bulls buy above 40. And I would not forget the FOMC report. If I were holding going into the FOMC report, I would not get out below 47 or 49, even though they're bear bars. FOMC report, bad follow through 56. Theoretically, you could buy above 58, taking a chance that we get above the all-time high. I'd get out of longs below 59 or 60, and bears would sell below 60. Bulls buy 63, bears sell 66. I would get out of short 68 and not buy 68, and bears have to sell again below a decent bear bar, and that's 71, and they got to swing down to the end of the day. For stock entry traders, the first reasonable one was below 3, and then 4, 5 closing on their low. 6, I would not take that short, even though it's 4 bear bars. It's a big bar collapsing at the testing the moving average. The bulls will try to get a high 2 buy, bar 2, bar 7. I would not take those buys. Next trade that I would consider would be 17, double top bear flag. 14, I did not take that. I did take the buy, but instead of buying above 18, I bought above 19. For the bears and stops, I think it's reasonable to sell below 29, better below 30, 31, 32, 33, 34, 35, 38. And for the bulls, buy above 40, 41, 42, 45. This is too close to FOMC. I would not do that. Theoretically, it's a buy above 55. I would not do it. Makes better sense to buy above 58 and then sell below 60. 62 is a sell, but it's similar to 6. There might be buyers below, so not a good sell. I'd buy above 63, sell below 66, and then sell below 71, 73, 74, 76, 77, 78. Limit orders, probably buyers below 1, probably sellers above 2. Not all that great. Probably sellers above 7 after the 4 bear bars. And then the 3 bull bars up to 9, probably buyers not far below 9. And buyers below 14. Up here, probably buyers below 21. And you have to go a long way down before you have sellers, and I would not sell there. Probably buyers below 43. This I would ignore. 56, bad sell despite the double top. Probably buyers below. I would not do it. 57, it's a high one with 2 bear bars. Probably sellers above. I would not do it. I'm only interested in stop entries on the FOMC report. 64, very good bull bar. 63, probably have to get above its high, especially since we have a wedge or an expanding triangle, and therefore there are probably buyers below 64. And here, no limit order trading. Buy the close, sell the close. Probably sell the close on 5 and 6, but I would not sell 6. And then buy the close 26, 27. I would not buy it because we may get a double top at the September high. And then sell the close either 31, 32, certainly 32, 33, 34, 35. And then buy the close, no more than I would do for the rest of the day. Sell the close 62, but only if you can put a stop way up here. And then sell the close again, maybe below 71, and then 73, 74, 76, 77, 78. To me, this looks like a good candidate for the start of a pullback on the daily chart, profit taking on the daily chart. Perfect double top with the all-time high, and an outside down day after an outside up day. So I think we're probably going down for the next week or 2 or 3, possibly a couple months. With the questions, try not to make them too long because they'll have a lot of parts and it'll be hard for me to keep them straight and very hard for people listening to keep all the parts straight. Question: how can a trader not be a scalper if he has a psychological preference for a high win rate? The probability of winning is high if you take quick profits. The trader's equation is positive if you exit loses quickly, and opportunities are bound. How can a scalper get used to a lower win rate of swing trading? That is tough. Most traders, when they start out, are drawn to scalping, not because of the profit, but because of the risk. When you're scalping, you're going for a small reward, and you're typically using a tight stop. And that's one of the reasons why most traders lose money early on. They're scalping and they're using tight stops. And the risk is usually bigger than the reward, and they're not good enough to take trades that have high enough probability, and they end up losing. So, you sometimes hear me talk about the Walmart strategy, and that means if you take a trade that looks like a reasonable swing setup, like selling below 60 or selling below 30 or buying above 40, you take the trade, you put the stop in, and walk away from your computer. You put a limit order in also to take profits at least 4 points away, and then you go away from your computer for a half hour or an hour and come back. And 40% of the time, you'll have 4 points profit, and 60% of the time, the market will be around where you got in when you get back. And I don't know what percentage of the time your stop will get hit. Maybe 20% of the time your stop will get hit, but most of the time there'll be a small loss or a small win. But 40% of the time, you'll get a reward that is at least twice as big as your risk. And beyond that, it's just a question of discipline. You're just forcing yourself to take the trade and let it go until there's either an opposite signal or until your premise is no longer valid. And I understand it's hard, right? Especially if you have a very active mind and you get restless and you feel like you always have to be doing something. If you're a micromanaging type of personality, which I am, it's hard to develop the ability to just sit there and let things happen and just rely on your stop. But I do think you can get there. It's just another mistake that beginners make is they keep flipping down to lower time frame charts, 1 minute chart, 2 minute charts, 3 minute charts. And they get in on the 5 minute chart and then they put a stop based on the 1 minute chart to try to reduce risk. And they end up getting a lot of 5, 6 tick losses. And it makes it impossible to become consistently profitable. So another alternative is just to trade always in. So you try to be in the market all day or most of the day and just let the market ride. So you sell below 4, you buy back your short above 8 for a loss. You can maybe sell below 17, you definitely buy above 19, and you sell out up here. You get short below 30 or 31, you get out above 40, you buy above 45. I would get out before the FOMC report. You either buy above 58 and sell below 60, or you simply sell below 60, buy above 63, sell below 66, exit shorts above 68, get short again below 71, and you hold. And if you do the math, it's actually a very profitable strategy. Okay, question. Yesterday, 78, 80, and 1 today, a parabolic wedge. You probably were not in the room, but I did say that it was a parabolic wedge. That we had 3 pushes up, 1 pullback, 2 pullback, 3. Anyway, in a fall below, in a failed breakout above yesterday's top, and did the market become always in long 63, 65? Let me check. No, I don't think the market was always in long here. I thought it was a good minor reversal. And then, or 68 through 70, I don't think it became always in long there. We're still below the moving average, and we have a weaker buy signal bar, 68, and we might get a double top bear flag. And did it reverse always in short on 71? I think it was always in short. I think it was always in short on 61, definitely 62. And a minor reversal up here, minor reversal up here, and the lack of consecutive big bull bars here. It stayed always in short. Bears get out above 63, they sell again 66. They get out above 68, they sell again below 71. I don't think it became always in long in here. All right, so this is, I think, pretty interesting stuff going on. For 4 months, if you began trading in January, you're assuming that the market is going to be in a small pullback bull trend forever. It's not. And we had an attempt here to end it, and we went to a new high. And now we're getting another attempt here with an even bigger bar and an outside bar. This is a better attempt. So I think better than 50-50 chance we've begun at least a week or two pullback, probably to this breakout point, this gap, maybe down here, and it might take several weeks. All right, hope everybody has a good night.